Australia's GDP looks to take another hit. Let's have a look. Hello everyone, I'm Florian Heise and welcome to another episode of Heise Says. I've got my ever-faithful stein of coffee powering me through the day, and I thought we'd have a look at this article from ABC News about Australia's GDP set to take another hit. Let's have a look first, before we jump into the article, just about what our GDP is sitting at. So GDP stands for Gross Domestic Product, and the website I brought up here is Trading Economics. It is a very useful website if you want to find out any stats or information about any country. And I quite like it. So, the gross domestic product in Australia was worth $1,432.2 billion US dollars in 2018. The gross domestic product value in Australia represents 2.31% of the world economy. Okay, so just think about that, guys. We're 2.31% of the world economy. I think we're doing pretty good for a little colony on the edge of civilization. GDP in Australia averaged 435.12 US billion from 1960 until 2018, reaching an all-time high of 1,576.2 US dollar billion in 2013 and a record low of 18.6 billion in 1960. So you can see here with the figure from 2018, we're in 1,432, and let's go 5 years. Okay, 10 years. Let's see what the max data is. So there's the max data. You can see we shot, up, and it tends to shoot down from. I wonder what year that is. Was that 2008 there? It's kind of funny with the scales. Probably in the half, yeah. In the half. One thing that's of concern is when we're looking at these figures. And this is a quote from Matt Berry. In 2016, 67% of Australia's GDP growth, so the growth, came from the cities of Sydney and Melbourne, where both state and federal government has done everything they can to fuel a runaway housing market. The small area from Sydney CBD to Macquarie Park is in the middle of an apartment building frenzy, contributed 24% of the country's entire GDP growth in 2016. And this is a quote from an article that Matt Berry wrote, and I suggest you have a look at it. I've got the link for it down the bottom there. It's quite concerning just how much of the GDP growth in 2016 came from a residential development boom, an apartment boom. So keep that in mind when we're looking at this article, because even though previously today I spoke about the auction hovels that are going for millions of dollars in Sydney, where essentially people are buying land and junk. So GDP to take another step down, but how low will it go? You reckon we can hit the 1960s level again? I say that half jokingly, half scared. Let us know what you think, guys. To paraphrase rampaging Roy Slavin and H.G. Nielsen, who in turn paraphrased Mark Twain on whiskey, sometimes too much data is barely enough. This week, the economic pointed heads will be swimming in a torrent of numbers, climaxing with Wednesday's release of the June quarter national accounts. After poor construction and investment figures last week, any hope of a reasonable GDP growth number is pinned on second quarter company profits and Tuesday's net exports and government spending data. What do you reckon, guys? What do you think? I'm not confident. I'm not confident. Maybe I'm reading too much news. Ahead of this week's GDP partials, the consensus view is economic growth of just 0.5% over the quarter or 1.4% over the year. That would put economic growth in line with the GFC's target of 1.4% recorded in the third quarter of 2009. Bugger. Or the GFC's trough, not target. So we're replicating the previous global financial crisis, aren't we? Remember, we haven't gotten recession yet. We're in a per capita recession, but not an actual recession. That's quite a step down from the already insipid 1.8% in the previous quarter and well below the RBA's forecast. So if the RBA can't forecast the economy accurately, and they're using modern monetary policy to control this, I mean, why does anyone have any confidence in any of the forecasting that they put forward, or any of the decisions they're making? Seriously. However, it might also be optimistic. Okay, ANZ, not renowned as the gloomiest house on the street, can only come up with 0.2% over the quarter, which would see annual growth dip to 1.1%. Putting to one side the fourth quarter of 2000, where GDP growth was hammered by the introduction of the GST, 1.1% will be the lowest reading since the early 90s. So here you've got year-on-year and quarter-on-quarter growth. So here's year-on-year. There you go. So everyone remember that, the recession Australia had to have in the 90s. So where are we trending, guys? Where's it trending? So remarkable collapse. 3 months ago, ANZ was in step with the 0.5% club. The collapse in GDP is remarkable, ANZ's Felicity Emmett said. Not how is it remarkable? It's happened in the past. It's happened in the past. I mean, look, there you go. 2000. Why am I writing in with blue on black? Hang on. I'll do green. Green. There you go. There you go, there you go. So, we had a little bump there. So, we need 2 quarters, so that was technically a recession there. 2 quarters. So, in quarter 2 last year, GDP growth was running above 3%. Business conditions were only just off their all-time highs, and growth in consumer spending was accelerating. Consumer spending, housing, construction, and business investment have all slowed more sharply than we anticipated. Well, yes, perhaps that's an issue with your modeling. We expected this is due to a combination of disappointing household income growth, non-existent household income growth. It's actually gone negative, and I will link to that video. I'm just going to write down the time here that I did, where our living standard and our disposable income is declining, guys. Falling house prices, the wealth effect, and uncertainty created by the global economic backdrop. Trump tweets. Well, you can't model that in. That's the problem. When anyone makes these predictions, you can't model in the unknown. So with regards to the environmental concerns that Greta and her followers have, they can't model in a disaster or just a bunch of volcano erupting. And that can have tremendous impacts on everything. It can kind of negate everything that they're doing. So, and you've got to remember, all these, particularly from the climate change radicals that want to have drastic economic changes, that will have impact on cost of living, impact on quality of life. Just look at the energy costs for people in South Australia. Okay, guys? Nothing is free. Nothing is free. I know the socialists want to think everything's free and the government just gives it to you, but someone else always has to pay for it. One environmental policy here, someone else is going to pay for it with a decline in the quality of life over there. It's just that simple. It's just that simple. There is balance. You'll get it. And it's suffering. I need a coffee. Okay. In keeping with the cycle of these things, the RBA board meets the day before the GDP numbers drops. The betting is rates will be on hold at 1%. CoreLogic publishes the August house price index on Monday, with strong auction results in Sydney and Melbourne forecast to see prices rise above 1% nationally. July retail sales Tuesday will be keenly watched. They are tipped to have increased, but at slower pace than June, as the full impact of the tax and 2 rate cuts will not have flown through to consumers' pockets by then. Really? Really? Well, we'll see. We will see what happens. The July trade balance should be another booming surplus, up about 8 billion. It's been like that on the trade front for a while, so much so that the net trade surplus of above 20 billion in the June quarter is likely to have more than offset the net income deficit and delivered the first quarterly current account surplus since 1975. Really? really, let me have a look at that. We'll bring up the Observatory of Economic Complexity, and we can see here our trade balance. I'm just going to bring it to full screen so I can look at it over here. 2015. Yeah, didn't we have a slight trade deficit there? 2007. Because, you know, red is the exports, blue is the import. Oh no, exports, red are imports, blue are imports. No, I'm getting it confused. Blue is what we're exporting. As of 2017, Australia had a positive trade balance of 44 billion in net exports, as compared to their trade balance in 1995, where they had a negative trade balance of 1.17 billion in net exports. So 95 we had a negative. Down here. So it's whenever the red is above. 99 we had. Between 2003 to 2007. And just recently in 2015. So, okay, sure. More than, okay, so we'll keep going. But why so miserable? On some estimates, including the Bank of England, global interest rates have never been lower. The BOE charted the rise and fall of rates over 5,000 years. So it's a fair period of... No, they didn't. They did not over 5,000 years. They haven't been doing it for 5,000 years. They just looked back at different ones, and some banks didn't even exist that long. What the hell are we talking about here? What? 3,000 years BC. I mean, come on, guys. You didn't have Anyway. Both long and short rates have sunk lower since the chart below was composed last year. The only time when rates were nearly so low was during the global depression of the 1930s, a period of chronic economic misery. I mean, yeah, 5,000 years. Yeah, they've got interest rates from then, from 3000 BC. I mean, come on, guys. What the hell are we kidding here? You're comparing a fiat currency system with, you know, gold and silver-based systems back here. Sure. Well, maybe they need to look at that. Maybe they look at... What about that? Let's bring back some of the debt jubilees that they used to have in ancient civilizations, ancient times. There's a lot we can learn from the ancients, guys. So the misery index. This will be cheery. I'm definitely having a coffee. So how does the current historic era of low rates line up in terms of economic misery? On an objective economic measure, there's an argument that things aren't so gloomy. In the 1970s, US economist Arthur Oken developed a misery index to study the twin evils of high inflation and high unemployment that were ravaging developed economies at the time. At its simplest, the misery index is the sum of the unemployment rate and the inflation rate. The higher the index, the worse the economic fundamentals, and therefore the public welfare. Currently, the misery index across the 10 biggest economies is in the basement, driven down by very low levels of both inflation and unemployment. Oh, that's good. Bank of America Merrill Lynch, currency strategist Athanasios Vambakidis says, looking at the misery index, current fundamentals do not justify the aggressive rate cuts from the G10 central banks. His preferred measure of economic misery is a bit more advanced than the old unemployment plus inflation method, factoring in existing interest rate settings as well as economic growth compared to long-term trends. Although global growth has weakened and inflation is below the target in most G10 economies, monetary policies are already loose, unemployment at a historic low level, and wages are increasing in most cases, not in Australia. The Fed has been at the forefront of the latest round of cuts despite US GDP growth being relatively solid and certainly in line with expectations, unemployment holding at 50-year lows, and inflation being around the target level or even above it in some measures. Global risks have increased, but monetary policy may not be the best way to address them in some cases, he argued. Well, yes. Dr. Vambakidis' view is that the risks that monetary policy is trying to address are primarily the result of policy failures in other areas, which more central banking easing is unlikely to fix. I think that's an accurate point there. I mean, they really can't do anything about it, can they? Such risks include trade tensions between the US and a number of other countries, the limitation of Germany's export-driven growth model, and the failure of the country to implement fiscal stimulus, political risks and unsustainable fiscal policies in Italy, and the risk of a no-deal Brexit. Central bank easing may actually allow such policy mistakes to continue or even worsen, he warned. If there is one of G10 central bank which has room to cut and still have an impact, it may be the RBA. Really? Really? With only 1% left on the BOAML misery index, only the Canadian currency is in a more miserable state than Australia. The index is low for all G10 no matter what, Dr. Van Vakardis said. It is slightly higher for AUD because of the relatively higher unemployment, but also because of the policy rate being 1% instead of 0%, or even negative in other countries. You know what? I'd like to invent a new misery index, and rather than combining unemployment, I would like to add underemployment to it. That would be interesting. I think that would be a smarter way to look at it, particularly with just the current gig economy that we have, or the fact that people are being employed by third-party contracting firms. So markets, perhaps having exhausted themselves after running in and out of the exits in response to the oscillating nature of White House communications on trade, Wall Street traders took a breather on Friday and went nowhere. The ASX 200, having gained 1.5%, or 28 billion, in the interest of balancing the scary X billion loss headlines in recent times, also looks set to take a breather to start the week. So Friday's markets on Friday closed. Yeah, well, ASX was up 1.5. The dollar was at 67.4 US cents. Dow Jones was up 0.2. Euro FTSE was up 0.3. Commodities, Brent oil was negative 1.1. Gold was down. Why don't they have silver on here? Well, not everyone's a silver bug, I guess. Friday's rally helped drag the ASX into the black over the week, but it still dropped 3% over a month, dominated by the release of corporate Australia's full-year results and rising unease of global prospects. It's difficult to apportion blame, but neither theme was overly positive. So we've got the self-reporting season. Depending on your taste, the reporting season was either Blunkmensch-like, a bit soft, or a curate's egg, partly good or partly bad. Okay. I need to learn. I've just learned yesterday what spirit animal means. I frankly think it means a lot of the Keynesians and Chicago school and modern monetarists need to learn the Austrian school if they seem to think it's all voodoo magic, people's, opinions and emotions in economic decisions. It just shows you the fundamental flaws in their methodology. So Morgan Stanley strategist Chris Nichol said the result season coughed up one of the weaker growth outcomes for some time, and looking ahead, the prospects were more downdraft than uplift for 2020. Morgan Stanley's key observations included earnings beats to misses were below expectations, revenue growth was below expectations with 10% of companies exceeding forecasts and 18% falling short. Healthcare, industrials, telecom, and info tech on average performed strongly in terms of market reaction, while miners and consumer staples disappointed the most. Of companies that provided earnings guidance, only 18% provided upgrades for next year compared to 39% guiding down. Well, there you go. Dividends were broadly in line with estimates, although miners disappointed and financials gave more positive surprises. The current stimulus has certainly subsidized some of the downsides from a domestic perspective, but to give a credible recovery in motion, we continue to call for additional stimulus and not just rate cuts, Mr. Nichols said. Here we go, iron ore. Iron ore has just suffered its worst month on record, with prices dropping above about 30%. Okay, and we can see that in the chart here. That's a big concern considering how much of our exports are iron ore in Australia. There are a number of factors. Increasing supply as Brazil re-enters the market, falling profitability in the Chinese steel mills, and concerns about the slowing global economy. Iron ore suffers the biggest loss. Veteran UBS analyst Glyn Lawcock said that despite the unprecedented volatility this year, prices may be stabilizing. Record Chinese steel output in the first half of the year has been principal in keeping prices at elevated levels and fundamentals tight. Is it topping out though? Potentially, Dr. Lawcock said. Official output in July slowed, while traders' steel inventory has lifted and rebar, construction steel, and hot-rolled coil manufacturing steel prices have slipped. Trade war headwinds have dampened short-term sentiment, but we maintain that any prospective Chinese stimulus will favor bulks such as iron ore and coal over base metals. UBS House view is iron ore is oversold, and its fourth quarter price forecast at US $90 per ton, well above the current spot price of 82 or 85 per ton. Really, let me just jump to trading economics to see what the current price is right now. And we'll jump to commodities. Iron ore at the time that I'm reading this is sitting at 86.5. So it's gone up a little bit. There you go. Okay. Oh, well, it's gone up a tiny fraction. Going into 2020, Dr. Lawcock says the market will come back into balance and the price will slide down to the UBS long-term target of 55 a ton. That's a big drop. That's a fair trek down, but still offering a pretty hefty margin for the miners on production costs of around $15 a ton. So, and then we've got the calendar of events that are happening. And let's see, house prices on Monday, profit inventories, manufacturing surveys. Tuesday, you've got the RBA decision, public demand, net exports, current accounts, and retail sales. Wednesday is the GDP. Thursday, the trade balance. And Friday, the construction survey. So, guys, that's kind of an overview of the gross domestic product and the economy here in Australia. How do you think it'll go? You think it'll be positive? Yeah. Do you think that a lot of the reaction that we're getting from analysts is because they're too young to remember the last time we were in recession? That's kind of what I'm thinking. Anyway, guys, thanks for watching. Like, share, and subscribe, and I'll see you next time.